Have you ever stared at a stock chart and it just felt like a completely foreign language? Well, today we're going to decode it. We're not looking at this as some confusing mess of numbers, but as a journey. Your journey. We're going to walk through the arena, peek behind the curtain at the forces at play, and lay out the strategies you can use to navigate it all. Ready? Let's dive in. So, what is the engine behind all this? What really drives the market? You know, it's easy to think it's just about earnings reports and economic data. But the real driver? It's this wild mix of cold, hard numbers and messy, unpredictable human psychology. So first, let's set the scene. I want you to think of the financial market as this huge arena. It's this dynamic place where all sorts of assets, everything from stocks to commodities, are being bought and sold constantly. And every player in there has their own game plan. Now, inside this arena, the players use a bunch of different tools, or what we call financial instruments. And a really powerful example is something called an option. Basically, it's a contract whose value is derived from another asset, like a stock. So if that stock's price moves, the value of the option moves right along with it. And options pretty much come in two basic flavors. You've got a call option, which is basically a bet that an asset's price is going to go up. And then you have a put option, which is the exact opposite. It's a bet that the price is going to go down. This simple little duality gives traders a ton of flexibility to build strategies for any kind of market, rising or falling. Okay, so you're in the arena, you've got a sense of the tools, but now you have to deal with the invisible forces at play. And these are the real challenges, the ones both outside of you and inside your own head that can totally change the game. First up, let's talk about the external risks. Systematic risk is the big stuff. We're talking about inflation, major political events, things that affect the entire market. You can't just dodge it by picking different stocks. But then there's unsystematic risk. That's way more specific to a single company. Think a product launch that flops or just bad management. That kind of risk, well, you can manage that by diversifying. But as important as all those outside forces are, they might not actually be your biggest hurdle. A lot of the time, the single biggest challenge you'll face is looking right back at you in the mirror. It's our own psychology. This is the internal battle every single investor fights. Greed is that little voice telling you to hold on to a winning stock just a little longer, right before it crashes. Fear and anxiety, that's what makes you panic and sell everything at the absolute bottom. Herd behavior is that temptation to buy something just because everyone else is. And overconfidence, well, that can lead you to take risks that you just can't afford. The first step to winning this battle is just recognizing that these voices are there. So you're up against external risks and your own internal biases. How in the world are you supposed to make a good decision? Well, this is where strategy comes in, and there are two major schools of thought when it comes to analyzing the market. The two main approaches are polar opposites. Fundamental analysis is all about being a detective. You dig into a company's financial health, the industry, the whole economy, all to figure out what a stock is truly worth. Technical analysis, on the other hand, just throws all of that out the window. It's all about reading the psychology of the market by studying price charts, working on the belief that patterns in human behavior can actually predict the future. And a chart like this is the natural habitat of a technical analyst. This is where they mathematically define a trend using what are called swing ports, those peaks and valleys you see. Look closely with me. In a healthy uptrend, every single peak, a higher high, is higher than the one before it. And every time the market takes a breather and pulls back, the valley it creates, a higher low, is also higher than the last one. That's huge. It means buyers are jumping in earlier and earlier. This sequence, this rhythm of higher highs and higher lows, is the literal definition of an uptrend. And the second that sequence breaks, the trend is officially over. So whether you lean towards fundamentals, technicals, or even a little bit of both, any strategy you pick has to fit into a bigger, long-term plan. This isn't about making one perfect trade. It's about building real financial security over time. And hey, you don't have to take my word for it. The U.S. Securities and Exchange Commission says it perfectly. For most of us, financial security comes from saving and investing over a long period of time. It's a marathon, not a sprint to get rich quick. And in that marathon, patience and consistency are your best friends. So how do you even start running that marathon? The SEC lays out a really simple but powerful roadmap. Step 1, make a financial plan. You gotta know where you're going. Step 2, get rid of any high-interest debt that's just eating away at your progress. And step 3, just start saving and investing, even if it's small. The most important part is just to begin. So there you have it. We've walked through the market arena. We've uncovered the forces working both for and against you, and we've looked at the core strategies for finding your way. The only question left is the one you have to answer for yourself. How are you going to take all of this and build your own plan for the road ahead?